Welcome to the Dakota Live podcast. I'm your host, Robert Morier. The goal of this podcast is to help you better know the people behind investment decisions. We introduce you to chief investment officers, manager research professionals, investment consultants, and other industry leaders to help you sell in between the lines and better understand the investment sales ecosystem. If you're not familiar with Dakota and our Dakota Live content, please check out our website at dakota.com. Before we get started, I need to read a brief disclosure. This content is provided for informational purposes and should not be relied upon as recommendations or advice about investing in securities. All investments involve risk and may lose money. Dakota does not guarantee the accuracy of any of the information provided by the speaker who is not affiliated with Dakota. Not a solicitation, testimonial, or an endorsement by Dakota or its affiliates. Nothing herein is intended to indicate approval, support, or recommendation of the investment advisor or its supervised persons by Dakota. Today's episode is brought to you by Dakota Marketplace. Are you tired of constantly jumping between multiple databases and channels to find the right investment opportunities? Introducing Dakota Marketplace, the comprehensive institutional and intermediary database built by fundraisers for fundraisers. With Dakota Marketplace, you'll have access to all channels and asset classes in one place, saving you time and streamlining your fundraising process. Say goodbye to the frustration of searching through multiple databases and say hello to a seamless and efficient fundraising experience. Sign up now and see the difference Dakota Marketplace can make for you. Visit dakotamarketplace.com today. Today, we are joined by Brian Labor, founder of Labor Investment Partners. Brian has over 25 years of investment research and advisory experience in the wealth management industry, including his role as director at Greycourt, where he most recently spent 2 decades. While with Greycourt, Brian was an investment committee voting member and led the firm's effort in recommending liquid and periodically illiquid public equity long-only and long-short public hybrid funds for ultra-high net worth families and family offices. The firm's clients included families with an average of $500 million in liquid net worth, with many exceeding $1 billion. Prior to becoming director in 2010, he covered long-only funds across equity, credit, municipal bonds, and rules-based tax-efficient strategies. Given the firm's focus on taxable investors, Brian incorporated after-tax, after-fee considerations into his research to ensure optimal net returns for clients. Previously, Brian was an analyst at CTC Consulting and an associate at Windermere Investment Associates, where he received his start researching hedge funds. Brian graduated from Portland State University with a BS in finance. Brian, welcome to the podcast. Thank you for being here today.
Thanks for having me.
So what's going on in Portland? Is it overcast as we assume it is, or has the weather been okay?
Pretty miserable here in terms of the weather. It's 9 months of rain most of the time in Portland most years, and we're kind of in the thick of it right now. So,
are you born and raised in Portland? Are you from the area originally?
Yeah, no, I'm a 3rd generation Oregonian, which is pretty unique anymore. But yeah, I was born in Southern Oregon and have spent all my life here.
So could you tell us a little bit about your journey into investments? So if you take yourself way back to Portland State University, what did you study for our students, and what were you thinking in terms of your career journey as it relates to particularly manager research?
Yeah, no, I mean, I definitely struggled a little bit in school with what I wanted to do in terms of a degree and ultimately a career. But when I started taking finance classes in business school, I really fell in love with the art and the science of finance, and knew that was something that I wanted to pursue as a career. And I was drawn to the idea of being a financial consultant at the time, mostly because I wanted to help people. I thought it would be a really rewarding career to be able to sit down with individuals and families and guide them to their retirement goals, or simply manage their wealth so they could pass that wealth along to their family.
Well, Brian, thanks again. It's really wonderful to have you here. Hey, could you start by sharing a bit about your journey into the investment world, maybe taking yourself back to Portland State, some advice that you give to students, and what that track looked like for you?
So after graduating from Portland State University with a degree in business administration, finance, I was fortunate enough to land a job at Windermere Investment Associates And this was really a combination of, being at the right place at the right time, a little bit of luck, and using my network. And I recognized right away that Windermere was a special place. The firm was founded by Dr. Nancy Jacob. She was, prior to founding the firm, the CEO of CTC Consulting. And prior to that, she was the dean of the business school at University of Washington. We had very sophisticated clients. Many of those clients had assets north of 500 million, and it was a pretty small number of clients. We did a lot of really great after-tax analysis there. And at Windermere, I met Greg Friedman, who recruited me to Greycourt, and he was a principal at Windermere. And it just kind of grew from there. There's definitely a really great network in Portland. I always joke that Portland's not exactly the finance capital of the world, but there are a number of really strong investment consulting firms. My journey continued from Windermere, which, is where I learned about hedge funds. And, I actually remember reading PPMs, writing profiles, and really just digging into that work and wanting to expand on that. And so I went on to CTC, and then ultimately Greg Friedman, who was CIO at the time, Greycourt, recruited me to Greycourt, where I spent 20 years. And that was another firm where I just really felt fortunate to be at the time. There was really strong investors at the firm. Mark Laskow, David Lovejoy, Greg Curtis, of course, Greg Friedman, Roy Nickel, and others that joined. It was a small firm where you had to wear a lot of hats. And it was a great experience.
As you think about your seat today, you are, an outsider looking in with all of this inside experience after all of those years, particularly with Greycourt. So what are some of the significant trends that you're observing in asset management today? Particularly looking at that experience with those ultra high net worth individuals and those family offices, how they're allocating their capital.
One big trend that is taking place right now is moving clients' active management risk budget from public to private. That is a trend that's been underway for a little while, and it seems to be gaining momentum. And I don't see that stopping anytime soon. And at the same time, there's a lot more capital being invested in low-cost, passive public equity ETFs. Investing to align with personal values very much continues to be a trend, and it's especially important to second and third generation members of a family. There's a lot of ways to express that in client portfolios, but there is a real strong demand for that. And then lastly, I would highlight China, the China allocation and what to do about that. At the beginning of 2024, there was about as much pessimism with regards to China as I've seen in my career. And there was a lot of talk about whether it was investable and should we have zero exposure. 2 or 3 years prior to that, the talk was, should we have a dedicated China fund? And should we carve out our China exposure? And so it's interesting how these things, ebbs and flows. But right now, there's definitely talk about carving out China to be close to zero, or utilizing more generalist global managers to pick up some alpha from China at times. But the China allocation continues to be, hotly debated.
When you think back at your seat at Greycourt, you're presented with a manager who does incorporate China as part of their selection process. It may not be a meaningful allocation, but it's an allocation nonetheless. And then they're presenting to you an ex-China strategy. So presumably it's the same team, it's the same process, it's the same approach, but they've taken out this allocation because of, potentially the pessimism. How do you think about that approach from the asset manager's perspective. So when you hear that being presented to you, does that skepticism sit in there, or do you feel like it's understandable given the dynamics?
Products exist for a reason in most cases, and there's a demand for carving out China to have EM ex China. My take is a little bit different in that I've looked at those in the past, and I never really liked what EM looked like excluding China. I mean, if you look at what then rises to the top, these are countries that are really no better than China in many cases. What's also interesting is that people deflect to India, and all of a sudden, India is this really great place to invest. And I'm also not really on board with that. My approach to China and allocation there would be more the long short option, because I mean it still remains the second largest economy in the world. There's still alpha opportunities. If you have a really talented investor that knows the market really well, you can go long and short and be profitable. I think it's an investable space. There's all the problems that we're well aware of in terms of slowing growth and the property bubble. But that doesn't mean that there aren't selective opportunities.
We discussed a few times before this podcast, you had mentioned short-term relative performance often matters, even for long-term horizon strategies. So how are you able to reconcile this dynamic when advising clients on manager selection?
I think it's an interesting part of being an analyst in terms of every day showing up to work, recognizing that it's a new day. It's what goes on in the markets is impacting my portfolios, my managers, and how are they doing versus expectations. It isn't to say that because of a bad week or a bad month that you would fire a manager, but you should be aware of what's driving that volatility intra-week, intra-month, and be proactive with reaching out to the manager and having a quick conversation. Sometimes it can just be a quick email. Often it is. Hey, I noticed that, your performance is kind of lagging quite a bit over the past, 3 weeks. Can you just give me a quick response in terms of what names drove that underperformance and why? And real quick response, here are the names. Here's what's going on. Great. I logged that in my files. I keep that in my notes, in the back of my mind. And that's a data set, right? Because often the environment that I work in, it's a lab, right? And I'm collecting data. And this, by the way, also goes for managers who outperform, right? It's not just underperformance. If a manager has really strong outperformance for a given period that exceeds expectations, I'll reach out just quick, hey, what drove that performance? This is all really important because it leads up to a point where it does matter. And when it does matter is when you have, consecutive quarters of underperformance, and you have a meeting with the manager, and you have this data set of points along the way that's helped build up to this point where you can ask really good, important questions. And so that's really, I think, not recognized is that short-term performance does matter. And it matters from an analyst perspective to be on top of it.
Interesting. Thank you for sharing that. It's a good insight. I think often when sales professionals and asset managers are approaching allocators and manager research professionals, there's this balance that they try to strike where, hey, we had a great last quarter. We're doing exceedingly well year to date, just to show you that, we understand what's going on today. But by the way, we've also done this, over a 1, 3, and 5 annualized, period as well. So it's a helpful insight, particularly from your seat with your experience in manager research. And so just thinking about that, this whole concept of can't eat alpha, the idea that excess return matters most versus beta 1 benchmarks, it's still often debated. So how does that framework shape the way, in your experience, LPs approach, long biased, alternative long biased, and long only strategies?
You can't eat alpha. I mean, it's just true, right? And extensive experience with long only and long short managers. And I kind of think about it in terms of a spectrum of, on the one end, you have long only, benchmark to the Russell 2, the S&P 500, to market neutral, plus or minus 10%. And then you have this like big gap in the middle, which is comprised of mid-net long short managers that tend to run, 30 to 60% net. In the world that I live in, the seat that I sit in, I need to benchmark these managers to an asset class. With the market neutral managers, I'm going to be looking at bonds, right? High yield credit bonds. In the mid net, I'm going to be looking at what their net exposure is, use a combination of equities and cash, really, or T-bills. And then, of course, the long only is going to be just beta 1. For managers that, fall into that mid-net, it can be really tough because, they are generating alpha on the longs and the shorts, and yet they're still being benched ultimately to a beta 1 benchmark, right? So even though I'm looking at their alpha generation, at the end of the day, over a 5-10 year period, I need them to outperform the Russell 2 or the S&P 500 or the Russell 1. It's not enough, to generate alpha if you can't still outperform the beta 1 benchmark in that setup. There's points in time where a mid-net manager makes sense. There's points in time where a market neutral manager makes sense. There's points in time where a long only equity manager makes sense. So today, right, I think US small caps are really attractive from a valuation standpoint and a catalyst standpoint. I want long only exposure for small cap equities. I have seen, interestingly enough, some hedge funds launch market extension strategies. And so even though their flagship hedge fund is running 40% net, they're also offering an extension strategy where they're going to be running 100% net. They still have the same longs and they still have the same shorts, but they're running 100% net. And that's I think a really nice solution if I want a long short manager in a volatile space like long short, but I want the beta. I want to be able to capture a good part of the beta, just because of the upside opportunity that exists.
We've kind of been touching more on outperformance and looking for those strategies that are going to deliver the types of returns you're hoping for than they are generally expecting. But in your experience, what role has behavioral finance played in how clients react to underperformance? So why and when have you found that clients decide to add capital to an underperforming strategy?
Yeah, I mean, behavioral finance is super important to understand. And it, in many ways, in most cases, it really drives, what clients want to do with their capital. With a manager, especially with a manager that's underperforming. And that's understandable because they're pretty removed from the analysis, right? From monitoring the managers on a day-to-day basis, from the original underwriting. So it's understandable that the reaction is going to be negative to underperformance. And, I can tell you living through it that it is true that clients definitely feel the pain of losing capital more than they enjoy making capital, right? And especially for the wealthy clients that I've advised to over the years. So there's certainly a behavioral component to it. And I think the question that I've been asked the most in my career is, why am I in this thing? And that always happens when there's some underperformance. It doesn't matter all of the research that I've done leading up to that point in terms of the underwriting and the ongoing due diligence, is when there's some underperformance, the question is, why am I in this thing? And it's a fair question, though, and it's why manager research exists. In terms of adding capital to an underperforming fund, I think that is probably the most important thing that a manager research analyst can do and add value. Not to say that it's easy to hire managers and fire managers, but it is incredibly difficult to add capital to a manager that's underperformed. And so how I think about it is, I need to frame up the underperformance. And so I look at historically periods of drawdowns, periods of underperformance. How does this current drawdown stack up to past drawdowns? And really analyze those drawdowns. How deep were they? How long did it take for the fund to recoup the losses? And really kind of frame it in terms of, is this the worst drawdown that the fund has ever had? Or is it kind of in line with historical drawdowns? So rank it in that way just to get a sense for truly, how bad is this thing? From there, I'm going to look at what is driving the underperformance. And so it's a combination of, basically getting the fund's holdings, looking at what name by name, which names have contributed to the underperformance, trying to tease out how much of the underperformance is attributable to macro factor style and how much of it is company specific. Company specific is what I'm going to focus on. There's not a lot I can do about, the factor exposures. And that's to me, that's noise. So with the company specific information, those names, what their weights are in the portfolio, what the drawdown, what the negative contribution was, I'm going to triangulate with other managers and just see, what the bear case scenario is for these if they're long. Other managers that I respect, are they buying more? Are they selling them? What is their perspective? And so I'm going outside of my specific manager's point of view and triangulating with other managers to again, this is a lab, I'm collecting data. So that's all research that I've done leading up to a meeting with the manager. I'm going to get on a plane. I'm going to meet with the manager in person. And we're going to talk about each position. What was the original investment thesis? Which, by the way, I should know. I have in my notes, but I want to have the manager articulate it again. What's the original investment thesis? What happened? And what do you think will happen going forward? And what are you doing about it? And that's a pretty dynamic, sometimes intense conversation, because ultimately I want to walk away with the answer of, is the research still good? And, so understanding what mistakes were made, how much of those mistakes were crystallized, and what's left in the book that can be recaptured helps me formulate how quickly the drawdown can be recouped. Because
how much weight?
Yeah.
Oh, go ahead, Brian.
No, I was just saying how much it can be recouped, because there's also the analysis of maybe this capital could be better used somewhere else where these losses could be recouped much faster.
Thinking about the qualitative attributes within that meeting, you are going on site, you are flying to meet a manager who's gone through a period of underperformance. To your point, you're looking whether it's idiosyncratic versus systematic. You're going to focus more on the idiosyncratic. During that conversation, how much weight are you putting on the portfolio manager taking responsibility for those mistakes, the conviction of, the initial thesis, and it just didn't work or it's not working? How much of that qualitative goes into that assessment that is clearly moded with quantitative rather? You've ring fenced it with the quant. Now you've got to go in and talk to the manager.
I really believe that I need to act on this, right? Doing nothing isn't an option, in my opinion, when you have a pretty decent drawdown for a fund. You're either adding capital or you're taking capital away. And I expect the same dynamic to happen with a portfolio manager, where they're talking to me about positions that they've added because they just believe that, there was a short-term issue and it's going to be corrected next quarter, or, there was just some exogenous risk that impacted the name, et cetera. Or that they said, hey, we got this wrong and we sold out. And that's fine too, right? That's part of the part of the game. You're going to make mistakes. You're going to move on. But there needs to be, and this is like as a manager research analyst sitting across the table, I am definitely assessing, how much, well, are they lying to me? Are they telling me the truth? How good is their research? What have they done to investigate why the stock lagged, right? Have they gone on a plane to meet with the CEO? Have they triangulated with their peers? And so it's like a very large qualitative aspect to this analysis in terms of interviewing the manager. And 9 out of 10 times, I know these managers really, really well, right? It's usually there's a long history. Yeah, I'm not an analyst that hires and fires managers quickly. So I know these managers really well, and I have a good reputation with them. I know when they're struggling and when they're telling the truth about things.
That's really interesting, Brian. Thank you for sharing that. I just want to pick up on something that you said I found was very insightful. You have this long history with these managers, multiple years of notes, as you said. Yet you ask them to articulate the thesis again. Why do you do that?
Well, it's confirmation, right? I have in my notes what the investment thesis is. Sometimes the investment thesis will evolve, and maybe I haven't picked up on that because it hasn't really been a meaningful position in the fund, or things have just kind of plodded along just fine, and we haven't really talked about it. And that creates a new dynamic when the PM says, "Well, yeah, we originally put the position in the portfolio because of reason A, but now we're in it because of reason B." That creates a whole another dynamic to investigate, to research. I'm not a big fan of that. I think that when there's sort of an evolution of the investment thesis, that's a red flag for me. It happens once in a while here and there. But in a scenario like this, where I'm trying to maintain my confidence in the manager, that would be a red flag.
When you're looking at managers and you're thinking about liquidity versus illiquidity, particularly lockups, whether it's a hedge fund or even a long-only portfolio, why would a 3-year lockup for a liquid public equity portfolio be a bad idea?
Yeah, this is just a heads up to maybe emerging managers or marketing professionals. And I would come across this every once in a while, where a pretty interesting strategy gets put in front of me from a PM that has a great pedigree, clearly talented, but their lock is such that makes me pass on the opportunity. And I'll tell you, it's really hard to sit in front of clients and tell them that I have this fund that invests in liquid, mid to large cap US equities, and they want to lock your capital up for 3 years. It just doesn't really fly with clients. They have capital that's locked up already in private equity and other buckets of their portfolio. In most cases, they're just going to pass on a situation like that. And so it's really unfortunate. And when I pushed back on it with the PMs, because I'll say, look, this is really attractive. I'd like to do more research, but your terms aren't in line with industry standards. And that's really important to us. And they'll say, well, we have a 3-year lock because we want to make sure that LPs are committed for at least 3 years. And to me, our clients are definitely committed to 3 years or more. But it's a question of, are you vetting your LP base right? Locking them up isn't a great way to screen for high quality LPs, right? And so, I think that it's just something that I've observed, especially over the last 5 years. There's more of an effort to try to lock capital up further in otherwise liquid portfolios, and it's just not something that works.
It makes sense. The one area I've seen it, I'd just be curious as an add-on to that statement, is around highly concentrated strategies, hyper concentrated. It seems like it still remains in vogue with both long only and long short to have very concentrated long only books. So 5 companies, 10 companies, generally 20 or less. So when you see that type of concentration, does it change your perspective on lockups?
If we're talking about microcap, then yes. But otherwise, you want an LP in your fund that has spent the time to get to know you, to really understand who you are as an investor, what your strategy is, how much vol should one expect, what's the potential drawdown. I mean, this is the work that I would do on any fund, but an investor should expect that from their LP base. And so, just because a fund is concentrated and potentially, there's some volatility and uncomfortable moments, they need to vet their LP base right, where they have the right LPs that can weather those storms and expect them at times.
Well, I'm going to ask you about some critical factors that you think about when you're evaluating public equity managers, but I thought we could do it in kind of a fun, creative way. One of the luxuries of your current advisory business is that you can kind of look at the outside. You can think about all those experiences of asset managers calling on you. If you can think of me as the asset manager, I've got a 35 stock US small cap equity strategy, long only. And I know I'm coming out to Portland and I'm interested in getting in front of as many people as I can. What do you first and foremost want to see in that introductory email? Let's say we don't have a relationship previously. What do you generally want to see out of the gate from an asset manager to help set the stage for you?
An understanding of the opportunity set would be the first thing I would mention, especially, US small caps, very attractive right now. Tell me why, your portfolio will take advantage of, the really attractive valuations and opportunity in US small caps. Second, tell me about the investment team. And this is something that I think doesn't get enough attention in decks and emails and presentations, is really talk about the decision maker and where they came from, who are their mentors, what skills do they possess that are differentiated. The bios and the intro bios that I see are, this is where I worked and this is where I went to school, but there's nothing of substance really there. And I think it's like super helpful for a manager researcher to narrow a universe if they understand a bit more about the individuals and their skill sets. Lastly, I would just make sure that there's a comment about alignment of interest. If you're independent, great. If you have a seed investor, state that up front and state why, that's an important thing for the firm to have. Because ultimately I'm going to want to know where the economics of the firm goes. And, if it doesn't go to the key decision makers, why not?
Just continuing this on, this is actually very helpful because I'm thinking about a salesperson. So your follow-up question maybe was around the portfolio manager, trying to understand them a little bit deeper, trying to gain that depth, what the substance is of who they are and how they're going to approach the opportunity. So now I'm sitting back in my New York office and I'm thinking to myself, do I bring my portfolio manager out to Portland for this meeting? It's the first time I'm meeting Brian. But I know they're looking at U.S. small cap. I've read it in his white paper. I've shared the opportunity set. I've told him about the team. What does that first meeting look like for you as it relates to the most optimal way to utilize your time as well as the asset manager's time?
I work on when I'm underwriting a manager, it's because I really believe in the opportunity set, that there exists an investment opportunity today, right? Mm-hmm. So I think first about the investment opportunity set. And again, we'll just stick to US small cap. I think it's a secular investment opportunity. The valuations look really good. I know I want to spend time looking at managers in this space. So like from the very get-go, you'll get my attention, right? If you're a US small cap manager. And it's different if you were pitching a strategy that's less attractive. Let's say, European small caps, right? European small caps. I'm not spending time there right now. And if you reach out to me for a meeting, I might want to collect some information about your firm and your fund, but I'm going to file it away, right? And if you happen to be coming through town, I might meet for coffee, but that's going to be the extent of it. But going back to US small caps, because I like the space, I would very much value the first meeting with the PM, because I'll already have the deck. I'll have your RFP. I'll have your performance. I've already done a lot of work on the industry in terms of your peers. I'll know how you stack up. With that first meeting, I'm going to be leveraging off of all that information to ask pretty granular questions about the investment process, how decisions are made, how positions are sized, mistakes that are made in the past. What have you learned from those mistakes? These are questions that more often than not are best answered by the PM.
Where do you like to see the salesperson in this theater? It's kind of, I always used to describe it as it's kind of a two-person play, right? You've got one person who's listening to, the big speech from the portfolio manager, the other side. And then you've got a salesperson who's kind of sitting in between. What is best practice from your perspective that salespeople should be following as it relates to, okay, now you're in the meeting, you have an opportunity to sit with the portfolio manager. What are you looking for from the business development professional?
Being attentive and following up should, never be okay after a meeting where I have to follow up. And I do, and it's fine. If I have a good meeting, I want more information, but like immediately after the meeting, I should be receiving an email asking what follow-up can we give you? What here are the deliveries from the meeting that we talked about. What else can I give you? And then and what's the best way going forward, to stay in contact? It's always been my experience as the most helpful. Because I dive really deep into strategy, into portfolios, and I ask for a lot of information. And I don't want the salesperson to, feed me answers. I want the data so I can analyze the data, make my own decisions, right? So there's a lot of requests being asked of the salesperson, but that's what's always been the most helpful is someone who's incredibly attentive, and I don't waste people's time, and maybe that happens too often in our industry. But I'm very transparent with my intentions. If I think there's, a good reason to move forward with a manager, I'll state that and I'll say, hey, here's what it's going to look like. I'm going to ask for this information. It's going to take this amount of time. And I'm going to go really deep. And you're going to get really annoyed by how deep I go. I guarantee you'll be like, what's wrong with this person? But at the end, they're just like, wow, us better than anyone. And we really appreciate all that you've done. And again, when you're dealing with a seasoned analyst, I can cut off the research point pretty early in the process, right? And so I really don't want to waste anyone's time.
Well, other than US small cap, what are some of the other areas of the market that you think are presenting some exciting opportunities today for LPs?
Yeah, U.S. small caps, value stocks, right? I would love not value factor price to book, but value stocks where you can find a manager that has a skill set in the space that knows how to tear apart a balance sheet, find hidden assets, looks for catalysts, knows how to work with management at companies, kind of friendly activist type situations. That's super attractive. And even more attractive than that would be long value, short growth for me. I think, a manager that has a history being able to exploit that dynamic would be super attractive right now. There's, I think, select opportunities in Europe for alpha generation. I don't like the beta in Europe, but I do think that there's a, it's a beat up market. There's good companies, and all you need is a little bit of sentiment to change to the positive, and the dynamic there can change pretty rapidly. One other space that I've liked is biotech. I think that there's been some pretty massive regulatory macro headwinds for biotech over the past few years, but innovation still continues to be really strong in biotech. And if you find a manager that knows the science, you can make a lot of money in biotech.
Mm-hmm.
And there I would prefer long short, just because of the volatility of the space. I'm not a big fan of sector funds, but biotech is one where I do think that you can find managers that have a really differentiated skill set, knowing the science.
Biotech is an area with longer time horizons. Do you think a lockup is warranted there?
Yeah, I do think there's, especially small cap biotech, you're dealing with pretty illiquid positions. And I actually like the hybrid approach. So hybrid, long, short, to kind of expand on it even more. There's opportunity for private equity investments in biotech as well that are short term in nature, and managers have exploited that really well in the past. But yeah, the lockup in biotech, I think something like a 1 year lock with quarterly 25% investor level gate, I think is reasonable in that space.
I could solicit advice for you for many hours, given how long you were doing manager research, particularly for our asset management clients and listeners here at Dakota, a number of whom are emerging managers. So less than a 3-year track record, generally less than $2 billion in assets under management. And they're trying to build credibility with institutional clients and gatekeepers, consultants. In an environment where it seems even more challenging to get somebody's attention, from the emerging manager's perspective, what advice would you be giving them to kind of crack into this network that relies so heavily on the type of research that you're doing and the time horizon as well?
I love finding new managers. I love emerging managers. I love managers that have so much to prove still. And I think that creates a pretty exciting opportunity to make money for clients when there's a long runway for success. I think my advice would be, again, to really understand, and here's just some advice that I often don't see from managers enough, which is to really understand your investment opportunity set, where we're at in the cycle. Really focus on competitive advantages. What's differentiated about your skill sets. This is something that really speaks to where the individual came from, who they were mentored by, what does their past successes look like? Why were they able to generate such outsized return in these positions, given the insights that they had? To really understand that and know it and to articulate it is super important. And then again, I would highlight that there's a alignment of interest, right? How much personal capital is invested in the fund, how do they pay their analysts? If there's incentive fee, how is that shared? Most important with that is how do they retain talent? To create a stable organization. Those are the conversations that I would have with an emerging manager.
How about the biggest challenges for asset managers over the next, let's say 3 to 5 years? What do you think are going to be challenging for those folks who are, going out to market, trying to define themselves in the context of the opportunity set? But there's certain headwinds that they may just not be able to get over. What do you think some of those headwinds are going to be for the asset management industry?
I guess my 2 cents there is, I do think we'll continue to see a loss of talent in the public equity space to private equity. It's sort of an evolution. It started with, hedge funds. There was talent drain from long only to hedge funds. Now it's hedge funds to private equity. That isn't to say there aren't exceptionally good long only, long short public equity managers out there. There clearly are. But if you're coming out of business school, there's probably a good chance that you're going to be looking at private equity at the moment. So I think that'll continue to be a headwind, but at the same time, an opportunity for some managers in the public equity space. And then the other trend is just the market participants in public equity and the impact that they have on market vol. And so the retail investor, for example, is a meaningful participant in markets and creating vol. Pods, quants, these are all regimes that I think investors need to be aware of and manage too with their portfolios in terms of understanding that the short term is going to be more volatile and there's opportunity with that volatility. You kind of have to extend your duration out with some positions and take advantage of the volatility.
Well, I was thinking as you were taking me through the scenario of emailing you and calling on you, I remembered my 26-year-old self feeling so good about landing a meeting with you in Portland, Oregon, to talk about long-only international equities. And I can confirm for our audience, you are transparent and to the point. I think I gave about a 20-minute pitch. I was by myself without the portfolio manager. And you told me it was an interesting strategy, but it wasn't for us. And you would continue to monitor it and for me to update you on a quarterly basis. But at that point, it wasn't going to work. And I remember feeling absolutely deflated. Like I had gone all the way. But looking back now as my 46-year-old self, how important that kind of intelligence is, when you're managing your time and you're managing expectations, particularly when you go back to the office. I'm flying out to Portland, Oregon. I'm getting a meeting with a notable allocator and a very, smart investment analyst. And to go back and be able to share why that doesn't work turned out to be a lot more valuable than, let's book a meeting in 6 months or let's book a meeting in a year. So I'm grateful to have known you this long, that I can recommend to asset managers to call you and Labor Investment Partners for some meaningful advice. And I want to thank you for, all your years of doing this so successfully. Thanks, Brian.
Thank you.
Brian, again, it's been wonderful to talk with you today. To our audience, you could find this episode and past episodes on Spotify, Apple, or your favorite podcast platform. We are also available on YouTube if you prefer to watch while you listen. If you'd like to catch up on past episodes, check out our website at Dakota.com. Finally, if you like what you're seeing and hearing, please be sure to like, follow, share these episodes. We welcome your feedback as well. Brian, thank you again for joining us. And to our audience, thank you for investing your time with Dakota.
Don't say goodbye.